Hey everyone, and welcome back to another episode of the Opportunity Podcast. I'm your host, Greg Elfrink, the head of marketing here at Empire Flippers, and today I have a very special guest. I have Brent Beshore, the owner and founder of Permanent Equity, a private equity fund that goes and buys mid-market businesses and SMBs, turns them around, scales them up. And one of the most interesting things about this is instead of like a normal private equity firm where they might hold on to your capital for 3 to 5 years and do a big flip at the end. Brent's company at Permanent Equity owns the capital or uses the capital on a 30-year term, which is very unheard of in the space. If you're familiar with private equity, how it works at all, is extremely unique. Brent is a fascinating guy. He does not have a finance background. He came from the other side of it, more of the operator background, the entrepreneurial background, which also makes him a lot very unique in this world of private equity. In my experience, I have always found that people who work in PE or the family offices, they tend to look at the operators with a little bit like, oh, well, you're like kind of beneath me. But really, the operators are the reason why those other jobs even exist, because the business isn't doing well. No one is doing well in terms of the investment. So this is a very fun conversation. Brent is super, super smart. I dropped his book a few times in the podcast, but just a third CTA, if you will, to start this podcast off. If you haven't read his book, The Messy Marketplace, you can go and get it on Kindle. It's a bit expensive. I think it was like $31. It was like textbook price, but I recently read it a few weeks ago and really loved it. And that's part of the reason why I got Brent on here to share some of his wisdom. So with that said, I'll shut up and we'll let Brent take it from here. See you guys on the other side. Bye. All right, I have Brent Beshore with me. I was just talking to him offline. I just finished his book, The Messy Marketplace. Fantastic book, Brent. I've been devouring your content for probably the last 2, 3 weeks. So I'm pretty excited that you're here. I was telling you, like, I wasn't expecting you to say yes to this. So, my audience that don't know who you are, could you give us a brief overview of who you are, where you are in the world, what's your claim to fame?
Well, I don't know about a claim to fame. I joke that I'm the Forrest Gump of private equity. I live in Columbia, Missouri. I was an entrepreneur and then accidentally bought a business in 2009. And that led into buying a variety of more businesses and realized that there was this big opportunity to help family owned sort of main street companies transition ownership. And so that's what permanent equity does. We're called permanent equity because our capital is functionally permanent. And yeah, we buy with no intention of selling the businesses. We typically use no debt in our transactions and take a really long-term approach to ownership.
So you have a very interesting career with how you got into all this. Like most people I've talked to in private equity, they have a background in MBAs or they worked with banks as investment bankers, but you really came at it from the other end, which I think is cool. It resonates with me because I used to be an oil field roughneck in the Arctic Circle before I got into this crazy world of internet marketing and micro PE and M&A and stuff. So like
It's a
I
very
feel
straight
you on the
line,
force.
you know?
Yeah, yeah, I feel you on the Forrest Gump of private equity thing. I feel like I'm that of internet marketing. So
There you go.
I relate. Like before you started permanent equity, what were you doing? Like describe the
Yeah.
business and what led to that path.
Yeah. So I was getting my law degree and my MBA at Mizzou. So here in Columbia, Missouri, which is where I live with my wife and my three young daughters. And I was getting my law degree and my MBA and had met this girl who I called the sexy scientist for a year before I asked her out. That's my now wife. She was getting her PhD and realized I didn't want to be a lawyer and realized that I probably didn't want to finish my MBA either. I was just ready to go out and do something. I'd been in school for quite a while and was just itching to go out and prove myself. And yeah, I had too much to drink one night with a friend and his wife wanted to start a business in event marketing. And I said, sounds great. I'll be the business side. I still don't know what that means. I don't think she knew what that meant. And it went about as well as you can expect. And so from that, launched an ad agency and then launched a research firm, software development firm, film company. And then had this guy say, hey, I've got this mutual friend. You should meet him. He just got left at the altar for the second time trying to sell his business. And I was 24 at the time. I thought that meant I should try to go buy his business because why else would you tell me that? He had no idea. And yeah, long story short, ended up getting an SBA loan, buying the business, and did well with it. I mean, there's a lot of ups and downs, a lot of eating glass, but yeah, did well with it. And then that launched really the realization that there was a lot of family owned businesses out there that needed help transitioning and a lot of opportunity. And so I made that my career.
That's awesome. I heard on one of your podcasts, I think you said something along the lines that your wife asked you, "How is this going to go if things go poorly with the SBA loan?" And you're like, "Not well. Like this will be very bad for
Not
us."
well. That is correct. Not well is a good way to describe it. Yes, that is correct.
You obviously took out a big risk to buy that business initially. Like, I don't know how big your ad agency was at the time, but based on what you've said publicly that I've seen, like it was a pretty risky thing for you to do. So how did you, for lack of a better word, have the courage to actually take that risk and go and buy that business?
Yeah, I wouldn't say courage. I mean, yes, it was courage. It was more just stupidity. I think I was young and dumb enough where I didn't really
There's
know
a
what the
fine line
consequences.
between risk or stupidity and courage, right?
Yeah, I mean, that's where I mean, truly, I owe most of my career to just some combination of ignorance and arrogance. It's like got into it. I had no idea how hard it would be. I had no idea, what it took. I remember I called up my local attorney and I was like, "Have you ever bought a business before?" And he's like, "Yeah, I've done lots of real estate deals." And I was like, "Is that the same thing?" And he was like, "Yeah, it'll be fine. Like all we got to do is due diligence." And I literally typed into Google DO diligence. Got to due diligence, right? And I was like, "Oh, DUE diligence. Got it. Due diligence." And oh, there are these lists that you can see. And oh, so you just ask questions like, "How hard can it be?" It was hard. It was risky. I mean, the reality of it is that you really don't know what you got in you until your back's against the wall and you got to make it work. I mean, look, that business turned out well, but it didn't have to turn out well. And there was a lot of hardship right after close, a lot of conflict. Anyway, it did not have to turn out the way it did. And, honestly, I mean, I joke that like I said, I'm the Forrest Gump of private equity for a reason. Truly, like, it didn't have to start out that way. And by the way, I mean, this is a little tidbit, but like I got to have dinner with Warren Buffett a while back and I got to ask him about the early days, right? And Dempster Mill and Sanborn Maps. And, everyone pictures Buffett as being this like sit in a chair, read a newspaper, let the phone ring, like very like sort of passive investor. The early days were not like that at all, right? In his 30s and 40s, like he was highly active. And in that point, he had almost all of it, at that time was the Buffett partnership, invested in these two companies, Sanborn Maps and Dempster Mill. And neither of them were going great. And Dempster Mill it was kind of a train wreck. And he met this guy named Charlie Munger, who ended up being his lifelong partner. And one of the first things they talked about, he said, Charlie said, "What problems do you have?" And Warren said, "Well, I got this company, Dempster Mill. I don't know what to do with it. It needs new leadership. I've never installed new leadership. I don't know what to do." And Charlie said, "Well, I know this guy named Harry Bottle. Let's go talk to him. He's an accountant. I think his background was like in accounting or maybe an audit." And anyway, they convinced Harry Bottle to move across the country from Los Angeles to the middle of nowhere, Iowa, and resurrect this investment, Dempster Mill out of nothing. And Buffett said to me, I asked him, I was like, if that doesn't go well, like what happens? And he goes, "If that doesn't go well, there's no Warren Buffett. There's no Berkshire Hathaway. Like nothing ever comes of it." So I feel like there are these, moments in time where things don't have to go the way that the way that things do. And there's a lot more paths that you didn't go down. And thankfully for me, that first business, Media Cross, worked out well. We still own it today. We have a great relationship. The CEO is amazing. His name's Jenu Mali. And anyway, it's incredible what happened since. So
That's awesome. Yeah, a lot of business is, those asymmetric bets, like you try to minimize the failure, but if you've like most of business I find is failure. And then you have those moments of success that just like shoot you up, right? Like gradually, not like crypto or anything, but the crypto people will calm down, right? So after you bought that business, it sounds like there was some trouble. And this is something I actually want to lean on a little bit because I find like I've been working in the M&A space and micro PE for about 7 years. And I find a lot of people, they think we've got this beautiful deal. I get the deal done and I win. Like I got the business, I got the profitable business. But in my opinion, like that is the second hardest part of buying a business. The first hardest part is after you bought it and actually are integrating it. So, like, what did you learn when you bought that business? Like your integration plan when you're buying these businesses, has it? Did you? I'm assuming you learned a lot of pearls of wisdom with that first one.
I would just say is I learned a lot the hard way. I learned that things never go how you think they're going to go. And maybe we could just zoom out. Like everything worth doing is going to be hard. If it's not hard, then like why wouldn't everyone be doing it? I mean, that's an adage, but it's like, it's totally true. And I think that a lot of people do look at the acquisitions process and say, okay, the hard part is finding a good deal. The hard part is negotiating it well. The hard part is making sure you diligence it well, get the documentation properly in place. And by the way, all those things are really difficult. It's a multiplicative system, right? So a zero in any of these is going to be a zero overall. But the really hard part and where the multiplication really starts to begin is post close. And turns out all business is hard. Turns out making money is never easy. And it doesn't matter what you're buying, there's going to be a lot of challenges with it. So, yeah, I mean, I learned a lot of recreating the wheels really dumb. I learned a lot of like, make sure you like listen though to logic and reason. I mean, I had a lot of things that I would ask the seller in that business as an example, like, well, why do we do things a certain way? He's like, because that's what we've done them. That's how we should do them. I was like, well, I'd like to change things. Right. And he was still working in the business at the time and just really resistant to any change. I mean, of course, he thought he knew how to run things the best way he could because he'd been running them that way, right? And so you're always going to have a situation with a seller where it's a little bit of damned if you do, damned if you don't, right? So if you change the business that they created and you do poorly with it, you killed their baby, right? Which is never a
Yep.
fun thing. And if you change things and they go better, then it's a little bit of seller's remorse. And we'll like, why in the world? How could he have done that? Right? Like, I'm an expert in this business. They're not, he's not an expert in the business. So I think that's where, really you've got to be able to have a pretty independent spirit when you're doing this and pretty thick skin and really just follow kind of wherever your thought process leads you.
Yeah, that makes sense. I can totally see the seller remorse. We call it postpartum entrepreneurial depression, like when they sell their business, right? Because it's like, I
Yes.
did it, and then like five
Yes.
minutes later, even though they got that big exit, they're like, I'm depressed. What do I do with myself? Like, what do I do
Right.
now? So when you got that business, how long was it before you started buying more businesses? Did you start buying businesses after that, or did you start the fund first to start buying businesses?
Yeah, so great question. So that was 2009, 2010. 2011 really started throwing off good cash flow, got the SBA loan paid back way early. And, at that time, I had started companies and now I had acquired one business. And, I had started a couple successfully and now acquired one successfully. And for a time there, it was a little bit of a split model in the early days. It was, well, why don't we have, and I still think this is actually probably the optimal, opportunity cost is to be able to have an opportunity cost between buying and building. But ultimately, you can only run an organization with one focus. And so we actually started a couple more companies, ended up buying three more companies kind of through 2015. Yeah, I'm trying to get my timelines right here. 15 into early 16, and then raised the fund. So it was a $50 million fund in 2017 and then raised $300 million in 2019. So it was a
Wow.
real acceleration, kind of from that point. Although, as I tell people, like we went slow and we're largely operating in anonymity for a long time to build our systems. Like people who think they're like, okay, I have an idea. I want to go buy, small companies. I'm going to go raise a 20, 50, $100 million fund to go do that. Like if somebody had given us $50 million when we were first getting going, we would have like lost all the money quickly. I mean, the market that we're operating in is highly inefficient, which means you can make or lose a lot of money quickly, right? Like go try to lose $1 million in the stock market. Like my argument's going to be, you're probably not going to be able to do it. Truly. Like go try to like lose money in like even reasonably capped companies. There's no way. There's no way. In fact, you might actually make a lot more money because you're doing something contrarian, right? Trying to lose the money. Like it just shows how efficient the public markets are. In the private markets, if you told me, hey, can you go lose $1 million? I was like, give me like a week. I can probably go lose $1 million.
You live probably
So
24 hours. Just come onto the
yeah,
market.
24 hours maybe. Exactly. Exactly. So, my point is just that, in inefficient markets, skill really matters, which is a great benefit to people who can become skilled at the art of doing what they're doing. So I think I still, I've said this for a long time now. I believe that the lower middle market, micro PE space is the most inefficient legal market in the world. And it means that skill matters the most in this area of the market. And I still believe that. And, that should be enticing and scary at the same time.
I love that. I teach my marketing team when I'm training up a new hire on how we, advertise to people, to these entrepreneurs. I always say at the end of the day, what we're really selling is not just a business, it's an opportunity, right? An opportunity to change your life. But I'm always clear that is an opportunity to change your life. And that could be both positive or negative. Like I can make you wealthy, or maybe we will help you lose everything. Like that's the
That is
way
correct.
that's the way it works with business, right?
That is the definition of inefficient market.
Yeah, exactly. So with your fund, I didn't realize you had started, relatively recently. I mean, it's only been really a few years, I guess over half a decade at this point, but doesn't seem that long
Yeah.
ago to me. Your fund is structured in a very intriguing way. So most funds I see, including ones we've done at Web Street, which is our sister company, they're typically looking at a like horizon of 3 to 5 years before they do a flip, get a bunch of liquidity back. But you don't do that. You have like a 30-year timeline. So talk to me about how did this happen? Was it a struggle to make it like that? Like, tell me the story.
Yeah, everything's a struggle. So yes, that included. But yeah, the story was that we felt like first principles. I mean, we don't come out of private equity, so there's no one in permanent equity who works at permanent equity that's ever been in private equity, and really no one who's been in finance. So I mean, everyone's coming from an outside view that comes with some advantages and disadvantages. Disadvantages are that you end up reinventing the wheel way more often than you should because you just don't know, right? The advantage is that you can look at everything from first principles. And so when we look at everything from first principles, we say, okay, how did families get wealthy? Somebody started a business and they compounded it, typically debt free over a long period of time. Like that's how families make a lot of money. I've never seen a family who's like, you know what we did? We took a business and we levered the heck out of it, sucked a bunch of the future cash flows into the present, put it precariously in a position to fail, and then sold it, thank God, within a short period of time. Like
Great
that's
pull
not the
there. Yeah.
founding story. That's not the story, right? I think when you look at traditional private equity, why is it structured the way it is structured? Is because of the LPs are in a position to only be able to give capital for a very limited period of time, right? And so all of private equity is set up for what we call the buy, lever, strip, and flip, right? And somebody's going to, maybe it's less leverage, maybe it's a little bit longer time horizon, but everyone about does the same thing, which is again, buy within a 2 to 5 year time period. You need to resell it. You're going to try to put in minimal equity, try to maximize the debt. Right now, there's a little bit different now with interest rates going higher. Let's put a little more stress on the system, but you're going to try to do something with it over a short period of time, put it on a different trajectory, and then sell it to somebody else, right? So that's kind of what everyone else did. Again, first principles, that's just not what I've seen do well for families. And so we just did was we said, okay, if we were the owners of a family business and we had built our life's work, we had people in the business who we loved and we trusted and we wanted the best for them. Yeah, sure, we wanted to get paid for our life's work, but like, what would we want? What's the product that we would want to sell into? And that's what we created. And we said, okay, well, there would be no time horizon, sort of an indefinite time horizon. We wouldn't have to sell. We wouldn't use debt. And we treat everyone really well long term. And so that's what we've done. We got LPs. Originally, we had asked for 50 years as a time horizon. And then we got whittled down to 30 years, which is, some hills you're going to die on and others you're not. And so we reluctantly gave up ground on that one. But yeah, and then our fee model is completely different. So our fees, we take no fees of any kind. We take no reimbursements of any kind. So there's no cash that comes from the LPs to the GP outside of once we start returning cash back, our investors get a preference and then we split the cash flows above that. So it's a very entrepreneurial system. And what we believe is it creates complete alignment between our investors down through permanent equity and then down through our portfolio companies and the leadership teams and employees. So everyone's operating on the exact same scale and eating from the exact same table. And it's really allowing us to say, look, if there's a dollar that should be reinvested back into the company and you can do it at a high rate of return and a high probability, for God's sakes, go do that. Like, we don't want the cash. If you can't do that, the worst possible thing you could do is hold on to the money. So again, it creates complete alignment up and down the stack. And it's really been a beautiful thing to watch how it works.
That's awesome. In terms of the investor perspective, so I guess they're just getting like quarterly dividends forever with the fund or for the
Yeah, we
30
don't
years of
have to
cash.
do anything. I mean, we're not required to distribute anything. Anytime we distribute, they get a preference on it. So we're typically doing twice a year distributions. Although during COVID, we decided not to do a mid-year distribution that year. And we just told our investors we're trying to play it incredibly conservative. We want to make sure we have plenty of dry powder to reinvest. And everyone was like, absolutely, keep the money. Like, for God's sakes, don't give it back to us.
Yeah. That's fascinating. What you said there with the strip, I do feel like a lot of entrepreneurs, especially when they're dealing with private equity, like I've dealt with a few PEs and family offices, and there is always that little bit of that feeling like I'm going to sell this to you and then I'm going to watch you destroy it and turn it into like this mean like product you can sell off to someone else. And I think a lot of entrepreneurs, to your point, don't like that. Like, a lot of these people have built like their employees are is somewhat similar to their family, right? So like watching like the
Or they're actually literally their family.
yeah, or yeah, often that is true. The wife is the COO or whatever, right? So I find that fascinating. I think it's a really cool model. Over your period of time since you start permanent equity, how many businesses are now underneath the umbrella?
Yeah, we have 13 active companies right now in the portfolio. So we're hopefully going to close on our 14th at the end of this month.
In terms of your buy box, like what kind of businesses are these? Are they online businesses? Are they brick and mortar businesses, service businesses? What kind of stuff do you focus on?
Yeah, it's a really diverse group of companies, both in terms of industry and geography. We've got everything from aerospace out in Los Angeles to
Wow.
manufacturing up in Michigan. We've got a software business in Duluth, Minnesota. We've got the nation's largest swimming pool builder. We've got the nation's largest fence builder. We've got a military recruitment firm. It's a really wide gamut of organizations. We own the highest in matchmaking firm in the world, so like executive search, but for love. Fascinating business. Never thought in a million years I'd be involved in that. But yeah, what we try to think about is in terms of the buy box, it's typically $3+ million of owner earnings. So, at the end of the day, how much cash is left over to either reinvest back in the business for growth or to distribute out? We want that to see that, when we purchase above 3 million, typically, we'll make some exceptions here and there. And then, up to about $20 million in owner earnings. So 3 to 20 million in owner earnings. We want the industry to be durable. So, we always have these kind of like little shortcuts that we think about for every business we get involved in. So for the pool business, it's look, until people stop dipping their bodies in water for pleasure, we think we'll be pretty fine. I mean, it's been going on for a couple millennia. You know, fences, we think fences make good neighbors, right? And fences have been around for a while. We think that people will want to continue to build fences. It's part of building code. We think that, unless fences go away, we should be fine, right? So those types of things that we look at as first, just, is it an industry that we believe is stable? Are they providing real value? And then look, can we buy it at the right price? Do we like the people? And then do we have a vision for what it looks like to hold it long term? So again, we're not looking to buy something that's a fad and then flip it to somebody else who, hopefully before it becomes not a fad. We looked at a lot of scooter companies a couple of years ago. It's like every scooter company in the world wanted to sell like 2.5 years ago. You see these like trends of like all these things that, people are trying to top tick the markets. And, we just don't play those games. We want stuff that's been around, been built by brick over a long period of time. Doesn't necessarily have to be brick and mortar or sort of like main street type businesses. I mean, again, we own a software business, but we want it to be something that's providing real tangible value beyond sort of a fad driven sort of shot in the arm.
Yeah, that makes sense. I like what you said about buying at the right price too, because like I feel like this happens on the buy and the sell side. Like the seller always wants to like sell at the top, and the buyer wants to get a good deal. But often these two things lead to a bad deal. In my experience, like the seller waits too long, or the buyer gets a great deal, but there is just a massive amount of fires going on with the business and very difficult to turn around. I'm glad you mentioned how diverse your portfolio is, because this is something I'm very curious on. Most private equity firms that I've spoken to and know, they tend to focus more on like one niche, have the synergy of scale, all that kind of stuff. So why did you choose just not to do that? Like, is there synergies like between these companies? Is that like part of your thesis? Like, tell me a bit about that.
Yeah, well, so it does look like we're agnostic, and we are by industry, which I think is where most people consider specialization. I would argue we're highly specialized, but just at stage of company. So we really like to get involved in what we call like adolescent businesses, where they're too big to be small, too small to be big. They're really kind of in this awkward in between teenager stage where they are good at the thing that they do, but they're not great at all the disciplines of the business of business. We think there's like an everything tastes like chicken layer of business. It doesn't matter if you're recruiting or building fences or building pools or doing aerospace parts. Like there's a certain like you got to have marketing, advertising, sales, you got to have an operations department, you got to have HR, you've got to have benefits, finance and accounting, like all these different disciplines within the business that have nothing to do with the actual delivery of the core product or service. So we like to get involved in businesses where we see lots of opportunity to improve, like I said, the everything tastes like chicken layer, business of business layer, while really trusting that the team knows what they're doing and can deliver a solid product or service for their customers.
So it sounds like you focus on, in a sense, like the back end, the operational side of it, like not on the fulfillment of the product or service, but you're looking to get the wins on the marketing, the sales, all that kind of stuff. Is that about correct?
Yeah, I mean, I would say we look at every discipline. So whether it's completely rebranding a company, it's developing a new marketing program, replacing an agency they're working with, redoing sales incentives, bringing in leadership in different areas of the business. We have a full-time executive recruiter on staff. We will get involved in completely gutting their ERP system, maybe implementing a new ERP system, gutting their accounting programs, implementing new banking systems, new lines of credit. It'll be new HR programs. I mean, everything that surrounds and enables the core action of the business. So we want to see a really strong, healthy core that is healthy despite lots of opportunities for improvement around it.
I like that. That reminds me a bit of a thing I tell business buyers. Like, I tell them, don't get obsessed with a niche, get obsessed with the business model. And I think that makes sense. So, like the way you're talking about that, because that really does open you up, because you basically building almost like a franchise system to be able to come in here and redecorate these businesses, for lack of a better word. You mentioned leadership team, like you have an executive recruiter. So, is it normal when you buy one of these businesses that you set up like a new CEO from like outside of the organization, or do you usually turn towards like internal leadership of the acquisition?
Yeah, it really depends on the situation. What we try to say is just no surprises. So sometimes we'll come in and we'll talk to the seller and they'll say, "Hey, look, to be honest, there's no one in here that can lead the firm. There's some good, leadership in the firm, but there's no one to actually step up into that CEO role." Fantastic. As long as we're all on the same page, that's what we need to do. Then post close, we'll go out and recruit a CEO. Or even maybe sometimes in due diligence, we'll do that. Other times, there's a great leader in place. I mean, the last acquisition we did, we absolutely fell in love with the CEO. Amazing, amazing guy. And we said, okay, who else do we need to surround you with? Well, we need to hire a controller, a CFO of the business. Great. We'll go out and help supplement that and augment that position. So we're really trying to look at what are we getting as part of the business and making sure that there's just no surprises. Our worst nightmare is, we come in and the seller says, "Yep, I want to stay on board for another 3 to 5 years. Everything's great. We've got a great leadership team." We come in and it's just a dumpster fire, right? Now, thankfully, it hasn't happened in a long time,
Everything
but
is
like,
fine.
yeah, everything is not fine. I'm like, the guy with the little cup, when the flames are
Yeah,
going around
that's
him. Yeah.
exactly what I was thinking of. Yeah.
Yeah, everything's not fine. So, yeah, I mean, for the most part, I think we've gotten pretty good at really understanding what the state of the business is in due diligence. And, we're pretty open and just having conversations with the seller and the team and saying, to be completely honest, you all, we see this as being lacking in these key areas. We're going to need to bring in outside help and resources. And if that's a problem, then let's just speak up now and talk transparently about it.
I like that. With most of these businesses, though, I would assume, and maybe I'm wrong on this, but I would assume the CEO would be the founder, like the actual seller of the business in most cases. Is that not the case? Do they usually have a CEO already in place?
It depends on the business. I would say, as we've moved up in sort of the size of business, the larger the business, the more likely there's going to be a pretty robust leadership team. So I would say 3 of the last 5 acquisitions have had a CEO in place that's not the founder and the primary owner. And that's actually really helpful for us because that shows us the durability that can be there. I mean, there's some fragility, of course, anytime with anybody that's, in a smaller company, but there is a certain type of extra special fragility that comes with the founder being the primary owner and the CEO and occupying all 3 of those roles. You pull that person out and you're just never quite sure what's going to happen. So we are particularly sensitive to that issue. And not to say that we don't deal with it because we do, but we're seeing it less and less often. It seems like that once you get to be a certain size and there's a budget to support professionalized leadership, it seems more the norm these days that people are exploring that before they have a sale.
That makes sense. I often joke with entrepreneurs, which they sometimes don't like, because entrepreneurial people, we tend to be a little bit like ego driven, like look how big what I built. But I always joke that you want to become the most useless player on your team. Like, if that's you, then you have a very sellable business. Like, investors love that. Like, oh, this guy doesn't
Amen
even
to that.
matter.
Amen to that. Yeah. I say that the pinnacle of business is to be always useful and never necessary.
Yes, that's a great way to put it. When you're looking at these deals, so you have such a wide variety of niches, how are you sourcing them? Is it mainly just your like content marketing efforts, like stuff like this, or are you doing anything else to find these deals?
Yeah, I mean, to be completely honest, we have been experimenting with going outbound and developing an outbound program, and we've really just never had much success with it. I don't know. Maybe it's just us. Maybe we have, a very punchable face or something. But for the most part, people don't respond well when we reach out. We get exclusively all the deals we've ever had have come inbound to us. So we look at a lot of stuff that comes across our desk. We say no to almost everything and try to really deeply engage and quickly engage in the things that look interesting. And I think we've gotten a reputation. We have on our website, we have a pledge, where we pledge to treat people honorably and respectfully and get back to them quickly and speak straight to them. And I think it's really resonates with a lot of people. There's so many games that get played in this area of the market, especially. and I guess finance more generally, that, we just really try to shoot people straight and treat them like we would want to be treated. So
I feel like your company and us are we're very similar in that vein. We tried outreach as well, but it just never works out well for us. We have a massive inbound
yep.
funnel to the point where our salespeople are only dealing with inbound leads, and it just works. It's really nice. It's a good position to be in. We would love to make a cold outreach to work, but just never been able to do it ourselves.
Yeah,
Um,
I completely agree. I don't understand it either. I mean, it should work, but it just doesn't for us. So
Yeah, like, it definitely works for my competitors. Like I know that they've gotten deals out of it that way, but for whatever reason, we can never get the magical formula to work on our side either. Which on the flip side, they all want what you and I have, which is
of
inbound
course,
leads, right? They're like,
of course,
why do you even matter to do this
grass
cold
is
outreach?
always greener. Grass is always
Yeah,
greener. When you figure it out, will you please let me know? Drop me a note.
I will. I'll send you the tips. When you're doing these business acquisitions and you're valuing them, valuation is a very messy thing, especially with smaller businesses. How are you going about creating that valuation to give to that seller? Like, this is what I believe you're worth.
Yeah, I mean, I think the way that the economy works, and this is the beauty of a capitalist system, is everyone's opportunity costs are different, right? So when somebody says, how much is a business worth? I'm going to say, well, who's involved in bidding on it and what are their opportunity costs? So we know what our opportunity costs are with, putting our money and our time historically into things. We're always trying to look at the reality of the situation. So what are our returns and what are we trying to exceed? So we have a number we try to hit. We're trying to, in general, hit at least 30% cash on cash returns over a 5-year period. That's kind of our minimum underwriting that we try to underwrite to, which is a high bar, very, very high bar. Now, how do we do that? We do that partially through the purchase price, and we do that partially through what we think we can help the business to grow into. So, each business is going to be some combination of yield at close combined with whatever the growth opportunities are of the business. And so, for us, when we're looking at it, we want to make sure that we're buying a fully loaded balance sheet. We want to make sure that we are with topped off working capital. We want to make sure that all of the compensation for all of the employees is fully accounted for, right? So this is another thing, especially in the lower side of the market that we saw, quite often was, you get people who are like, oh, my seller discretionary earnings are $600,000 a year. And it's like, well, sure, but it's going to take a $250,000 a year person who's really special and difficult to find to operate that business to where it'll spit off then, call it $250,000 or $350,000 a year. So is that business worth a multiple on 600,000? Not a high one, that's for sure. So anytime we're buying a business, we're trying to look and say, okay, if we want to hit those types of returns or exceed them, then what do we need to think today is true to make sure that we can hit that and leave some margin of error in there as well. And we're not using debt. So we're not getting a levered effect on our equity. So the business has got to perform.
I'm curious on the debt thing, but first I want to ask you a due diligence question. So in your book, In the Messy Marketplace, you have a line that actually made me laugh out loud when I was reading it, where I think you were talking about getting the prospectus and you start the due diligence and you said it to the reader, like, remember, your business will only look worse to the buyer from here on out. Like
Yes.
at the start of the due
Yes.
diligence process, uh,
Yes.
which I thought was very funny and
Nothing gets
very
better in
true.
due diligence. Nothing. Nothing ever gets better in due diligence. No one diligences a company and says, "Oh my gosh, this is absolutely so wonderful. I had no idea." It's like, no,
Look
it's
at all
always
these hidden
it's like
gems.
dating.
Yeah.
Yeah, it's like dating, right? It's like the first date. Like everyone's all presentable and fresh and flashy, and then all of a sudden, you're 10th date in and fighting about, who's gonna, order the crab or the salad. So
That's awesome. So talk to me about your due diligence process. I know this is something you do in house. I do have some buyers that they'll outsource it, but most of my best buyers they also do it in house. But what does your process look like there outside of the valuation stuff? What other stuff are you looking for?
yeah, I mean, so we have a 25-page single space checklist where the businesses we're getting involved in will oftentimes have, pretty historical environmental concerns. So we'll have to do phase 1, phase 2 environmentals, potentially some remediation. There'll be potentially trademark issues, patent issues, I mean, all the typical stuff that you'd think of us diligent. So we have a full team that we've built in house of experts who are absolutely phenomenal at getting at the core issues. The question's always what's included in the purchase price and what's not. So again, this is what I think a lot of sellers don't realize is the higher the purchase price, the higher the bar for due diligence and the lower likelihood of closing. To bring this down to earth, like let's say that you and I have a business throwing off $1 million a year and I go under contract for it to say, I'll buy it for $3 million. Okay, so it's a 3 times multiple on true free cash flow. I'm going to build in quite a bit of room there that I can find some maybe unattractive and hairy things that I can absorb and say, hey, that's part of the purchase price. I'll look past them. Let's go ahead and close. If that same purchase price, instead of being $3 million, is $15 million, like it better be an incredibly well oiled, like great growth trajectory, everything better be in order, or there's just no margin of error in that business, right? So again, that's where it's like, price is oftentimes the due diligence, and inverse of that, price oftentimes set up due diligence poorly, depending on what the situation is.
That's a very good framework. In my space with digital businesses, there's often an issue where a seller just, and I know this exists everywhere, but they have an outsized valuation in their head. I think in the digital space is especially apparent because they all think like Silicon Valley style multiples. Like we
Sure.
have e-commerce or drop shipping stores, that are lucky to get a 3x because the drop shipping has a very little moat, but they're like, why am I not getting like, what Facebook is getting? Like, well, because you're not Facebook. Like,
Correct.
so that is always a challenge with sellers. When it comes to the debt portion, this was also something very interesting that I thought was quite unique, that you don't really use debt. So from my understanding, you are raising the money and you are purchasing the businesses outright. I'm assuming there's like deal structures involved still with
Sure.
milestones and stuff like that. But why did you not take the debt approach?
Yeah, well, so if you think about it, the only thing that's sustainable long term is if all the stakeholders win. So it's got to be a win 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 all the way around. So if you think about who the stakeholders are, right? It's not only the buyer and the seller, it's the executive team, it's the employees, it's the customers, it's the vendors, it's the community, maybe it's even the regulators, right? So there's a lot of stakeholders. The only two groups that benefit from debt, and really there's only one group that really benefits from debt, is the buyer, right? If you have to put in less equity and everything goes great, then yes, you will generate a higher return, right? Whatever your debt is, whatever your levered effect minus your cost of capital, that will be the extra return that you add to the bottom line. It doesn't help any of the other stakeholders, and it actually hurts the other stakeholders. So now you have a source of cash that has to be going to that every month to repay debt, right? Pay interest and pay down the debt. That gives you, by definition, less flexibility to reinvest back in the business, less flexibility to grow. And when things get hard, which by the way, every business is going to have hard times, it forces you to cut people you don't want to cut. It forces you to cut much deeper than you would cut otherwise. And honestly, it makes you make decisions that are not in the long term best interests of the company. So we believe that by not having debt and having maximal optionality with the cash that these businesses generate, that we can endure far more, and we can actually reinvest in them in a way that generates better long-term returns than the use of debt. Now, I will caveat all that and say it depends on the business model and it depends on your time horizon. If your business model is such that it's high recurring revenue, it's high predictability, there's an incredible moat around it, yeah, of course you can. I mean, you still could screw it up by putting too much debt on it, but you've got a lot of margin of error to work with there, right? A lot of the businesses we're getting involved in are going to be cyclical. They're going to have business models that are going to go up and down. They're going to be hits driven. We're not dealing with a lot of recurring revenue type businesses. So we just have to take into account the business model and the volatility that's inherent in that, and take that into account when you're thinking about how much debt to use.
Yeah, I often tell business buyers you want to have the ability to fail a few times. That you should bake in the margin of error from the outset. We deal with a lot of new business buyers, as you might imagine, since we're on a much smaller end of the PE space. But they'll think like, oh, $100,000 business. Maybe it's a nice little content website that they're buying, and they just don't think about all the other money you're going to be putting into it after the acquisition, because they're like, that's not done. You're not done injecting the capital in just yet, right? So I like that. And I also like that you mentioned that it is sometimes okay because you use debt, right, with your SBA loan. So in certain
I did.
cases it can make sense if you're trying to get that next level going.
Yeah,
um
and we'll use lines of credit in the businesses too. I mean, we're just talking about debt at closing. Like we will oftentimes, if let's say we want to, grow the company very quickly and finance inventory, right? That's a perfectly good use of debt. But that's very different than, hey, at closing, I'm going to put in $3 million and I'm going to put $7 million of debt on the business, and here's a check for $10 million, right? Well, yeah, now you've got a business that may historically have been making $2-3 million a year, but almost 100% of that free cash flow with very little margin of error is going to be going towards the bank payments.
yeah, 100%. It's
It's a high
the
wire
difference of
act.
good debt, bad debt, right?
Correct.
Like the higher price you're paying for the business, the more bad debt that can lead into potentially.
Correct.
So once you've acquired a business, you mentioned a little bit of what you're doing, but maybe go into a little bit more detail, like what you're doing in terms of the sales, the marketing, the HR, the banking. Like, how does this all work together to grow the business? Because one of the things I'm curious about, like the fencing business, for example, those businesses tend to be like very dominant in local markets. And local markets aren't like a SaaS where you can just suddenly get like 1,000 new customers typically. So, well, like, how does all this like thousand cuts of improvement work?
Yeah, well, so one, we don't have a plan ever for the business. I mean, we have
Yeah,
opportunities that
nice.
we think that come up, but we never have a plan. I think this, idea traditional private equity has like a 90-day, 120-day plan. They'll often say like, we'll have board meetings once every 3 months. If we own the business for call it 3 or 4 years, that's very few times to impress the board. Like, don't screw it up, right? Like the guns to your head, like go as hard as you can and make a bunch of changes as quickly as you can. I think that would be a very stressful way to operate. And I think that would be a very stressful way to live. I don't understand how people do it. I admire that they can do it. For us, we like to take it slow and be intentional and build trust and build relationships. And so we tell people, look, we're going to try to be helpful, but we're not sure how we're going to be helpful until after we close the deal. And what we try to do is just get to know people and learn. And things will come up, and we'll say, "Oh, hey, we think that there's maybe an opportunity here with your marketing efforts. We see cost of lead gen as an example, or cost per action of whatever the action is that we're trying to elicit, of being typically lower in other businesses. Can we maybe dig into that? Would you be okay with us digging into it?" Sure, take a look at it. Maybe we dig in and maybe we don't find anything. Maybe we think everything's being run well and we don't have much to add. Oftentimes, we'll though dig in and find something. I would say the only times that we really do force the company quickly to make changes is when there's some line of either ethics or legality that we just can't tolerate. So we'll often, I mean, as you probably know, as you get into bigger and bigger businesses and more geographies, it's basically impossible to be within the law, every law, because laws conflict, right? I mean,
Right.
you'll have businesses where literally like you cannot be in compliance of every law. And sometimes you have to make hard decisions around what is to be complied with and what's not. We'll oftentimes come in and do a pretty robust study on where do we think that the liabilities lie in compliance or sort of legal capacities, and we'll make changes based on that pretty quickly. But other than that, I mean, look, if we're going to own this business for 15, 20, 30 years, like we're in no hurry. I think the biggest danger for us is that we upset the apple cart, and it's kind of like pulling on a thread on a ball of yarn. Like you think you're just pulling on one thread and then all of a sudden half the ball of yarn falls off the other side. Like you want to get to know what you're tugging on before you tug on it. And look, these companies are complex organisms that there's a lot of feelings, there's a lot of history and power dynamics that are just not obvious when you first get involved. And so it takes a little time to get your sea legs, understand, who does what, who's responsible for what, whose territories in what area, what's the history of that, in order to, properly make changes and not, like I said, upset the apple cart.
Yeah. So with all the businesses that you have, with your organization that's managing them, how have you structured permanent equity to actually handle these businesses? Like, what does the day to day look like where your team is running this portfolio effectively?
Yeah, well, so this is an area that we're also pretty different in. So, how you scale a traditional private equity firm is you add new partners. So, a partner's job is to basically do the entire thing all the way through. So, find opportunities, negotiate them, diligence them, document them, and then operate them post close. Sit on the board of directors, kind of be the liaison between the private equity
Mm.
firm and the company. I looked at that and I said, man, that's a lot of things to be good at. I don't understand how anybody could be good at all those things. I certainly couldn't be good at all those things because I did them all and I was not good at most of them, right? You kind of do them poorly. So I said, well, what if you create a system that was much more like a regular business, like a manufacturing company? And you would never have, one person that's like, oh, that's Bob. He answers customer calls and then he does some welding and then does the accounting and then also sweeps the shop floor and interacts with the bank. Like no one runs a business that way. That would be pure chaos, right? But that's what most private equity firms do when asking people to do all these different jobs. So what we said was, why don't we operate like an assembly line, like a manufacturing operation, where we have senior partner level people, but instead of them being responsible for the entire breadth of the operation, they go deep in one area. Like we think Adam Smith was maybe onto something. This whole specialization thing, like we think really can create benefits. And so, we have a team that post close, specifically talking to that, is split up into operations and finance. Operations team is largely interacting with the C-suite. Finance team is interacting with the financial teams of the companies. There's two really distinct feedback loop systems there to create information feedback loops that can be shared both within the companies and within permanent equity. And so every company post close has two people assigned to it, two primaries, and they're working with the companies on a day-to-day, week-to-week basis, and then they're pulling in outside resources, whether they're within the firm or truly outside the firm in the form of consultancy or a business a piece of software or something to help them. And so those two people are kind of the shepherds of the business post-close. And so we think it scales much better than traditional private equity and allows us to buy a lot of smaller companies and hold them for an extended period of time.
It's interesting you brought up the assembly line thing because I've often compared EF to an assembly line versus other brokers and marketplaces in our space. And the other brokers, they'll compete with us saying, white glove experience. Like, oh, those guys don't have a white glove experience. And my argument is like, the entrepreneur doesn't really want the white glove experience. They think they do, but they don't because, like you said, like if you're doing everything like as a one person, it leads to chaos versus one person who's very specialized at this one section of selling the business. Like we have an entire department that's just focused on vetting, like making sure everything is clean, right? We have two different sales teams, one on focusing on buyers, one focusing on sellers, right? We broke it down into that assembly line. So I think that is very wise is what you said there because I've had friends working at high finance and it is stressful, as you said. I know we're running short on time, but I wanted to ask you, what is your goal with permanent equity? Like, what do you want it to achieve? What's the ending line?
I mean, I think we're already there. I don't have another ending line. I mean,
Beautiful.
have been doing it for the money for a long time. I love what I do. I love providing opportunity for the people at Permanent Equity. I love working with families. I mean, the way we think about it is we get to be responsible for helping a lot of families flourish, and both the families that are selling to us, as well as the leadership teams, the employees. When you think about all the people that we have almost 1,000 full-time employees, like all the families and all the people around those employees that they touch, it's absolutely incredible. I mean, when you fold into the families that are the suppliers to us, the customers of us, it's wonderful, all the people that we get to touch. I mean, it also makes it hard. People are messy. We're messy. They're messy. So there's a lot of mess to always be cleaned up, but we try to be graceful in how we do that. And I mean, look, I never had a plan. If you had asked me 5 years ago where we'd be today, I wouldn't have told you we'd be here. It's always gone in different directions and been different than what I expected. So I'm just trying to be along for the ride and see what God gives me to steward.
That's great, man. I get a similar emotional feeling when I sell one of my friends' businesses. Like we had a content site. It was $1 million content site. And it took him a while to get the confidence to actually sell. Sometimes people are pretty timid about this. And he finally got onto our marketplace and he sent me a message over Facebook. He'd been on our marketplace for I think like 24 hours. And he's like, dude, you changed my life. I'm like, oh, he must have gotten like a really good offer. That was really fast, like, faster than I expected, right? But it turned out the offer was $1 million all cash, which almost never happens at that size. It's like, oh, damn, I really didn't expect that to happen. Like the deal's already done. So
That's
that
amazing.
was like cool stories like that, Not saying that's like obviously that's very uncommon for anyone out there listening. Don't expect that. Just
Sure.
like disclaimer. But those stories are cool, right? I guess my final question. Usually, I ask a rapid fire questions, like three of them, but I feel like it would be. I want to give you the last few minutes here. If someone was an entrepreneur, or maybe they were an employee at a company who wants to become an entrepreneur, and they're inspired by what you've done, and they want to do something similar as to you, what would be the plan and advice you give them?
That's a great question. One, I would tell them there's lots of opportunity in the space that we're in. So there's lots of opportunity here. I always joke there's gold in the hills, right? Kind of like settlers, though, it's going to be a lot of hard work and it's going to be a lot of stress and a lot of strain. And if you think it's easy, it's because you've never done it or you got lucky. Like there's no other two other options. Like I don't know anybody in the space who's bought multiple companies, operated multiple companies, who has anything other to say than, oh my gosh, you wouldn't believe the stories. Like stuff is going to get weird. Stuff's going to get hairy. It's going to be hard. And as long as you prepare yourself for that and give yourself enough lead time to really be choosy. I see a lot of people getting into it and they're like, hey, so the plan is within the next 3 months, I'm going to go buy a business. And then within this timeline, this is going to happen. I'm like, hey, that's great. That's just never going to happen. I mean, maybe, one out of 1,000 people get lucky and something like that happens. I always say that, if you're going to start from a dead stop, give yourself 3 years of runway full time to find the right business, buy it, and start to operate it. 3 years full time.
In
That's a
terms of,
long time.
yeah, it is a super long time, and I tend to agree with you. Again, it goes back to the margin of error. What advice would you give to raising money? I remember, I think one of your podcasts you mentioned the guy who convinced you to do this is kind of the guy that like helped you initially with like finding the money people, the LPs.
Yeah.
What would be your advice for someone who is raising their round to do something like what you're doing?
Well, I mean, I think it depends on what you're trying to achieve. If you're trying to build a holdco, you're trying to buy multiple businesses, I'd go about it very differently than I was trying to buy one business. And by the way, always start with one business. If you can't, you got to get one done successfully
Solid,
before you
solid
can get
advice.
multiples done. I don't know how many people who've never bought a business before who tell me that they're starting a holdco, and I'm like, a holdco of what? Like, there's no businesses. And they're like, yeah, well, the idea is, to buy more businesses. I'm like, yes, but you have to buy one to buy two, right? You don't automatically jump to the end of the line. So if I was going to start to buy my first business, I do think the SBA USDA program is a great program to use. It's not perfect. There's definitely risk. I mean, you're personally guaranteeing it, but it is the most flexible debt you can get. It's fixed rate, 10-year debt. I mean, that's the program I use to get into business. It comes with risk, though. I mean, look, like at the end of the day, you've got to take risk to make money. All investing is just assuming risk. It's just you better be aware of what risk you're assuming, and maybe you can mitigate some of that risk. If you aren't in a position to get a loan and you want to go out, I mean, you got to have a really clear story and you got to be very focused on what you're selling. I think this is another thing that's, hey, I'm going to go out, I'm going to raise money to buy a business. That's not really saying anything to anybody. I mean, if anybody's going to give you money, it can't just be, well, I'm going to buy whatever business just strikes my fancy. You need to get really focused on what are the skill set you're bringing to the table. Why do you think you'd be able to be operating it post close well? Why would investors be interested in giving you a check? What do they get? What do you get? And have everything be very crisp, clear, and clean from the very beginning, because things will only get messier, right?
Yeah.
And I too often see people kind of get squishy with details. Yeah, I kind of got a backing. There's some people that I think would give me money, and I'm going to go out and bid on some companies. And then look, it's really easy to go out and make promises, and your reputation matters. If you go out and make promises and can't deliver on them, it's going to be not a good situation. So get your ducks in a row before you go out and do that.
Great advice. Well, Brent, this was an absolute pleasure. I really enjoyed this conversation. We'll link to your book, The Messy Marketplace, for any sellers listening. Like, even if you're running an e-commerce business, I highly recommend Brent's book. It was really good, matched my experience at EF at least. But if someone wanted to contact you, Brent, or follow what you're doing, where's the best place for them to come hang out with you?
Yeah, I mean, we've got a really robust website, just permanentequity.com. I'm also on Twitter. My DMs are open. That's another good place to get a hold of me. So, yeah, look forward to trying to be helpful. And I really appreciate Greg having me on. And hopefully you get some sleep.
Yes, Brent just found out I'm in Vietnam. It's 1:30 a.m. or actually 2:30 a.m. now
It's
where
2:30
I'm
a.m.
at.
now. Yeah,
Yeah,
my condolences.
I'm
So
traveling.
I don't think I was worth it, but I appreciate it.
No, I enjoyed it, man. We'll have to get you out here. My family's actually from Missouri, so
Oh,
I'm
cool.
originally from Alaska, but my dad's from Leopold, next to Cape Girardeau. So maybe I'll come to
Yeah,
Capital Camp and hang out with you.
that's right, man. Well, you're always welcome. I appreciate you having me on. Have a great day. Okay.
All right, you too, man. There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.